Hello and welcome to Tranche B of our loan agreement. The Tranche B loan is totaled at $25 million with an annual interest rate of 8%. However, it should be noted that from the first to the fifth quarter of this loan, the company will be required to pay just the interest. Then from the sixth quarter right up to the 32nd quarter, the company will be required to pay interest as well as principal of the loan. To get things started, let us calculate the payment to be made. We start by determining the quarterly interest rate, which is equal to 8% divided by 4, and it gives us 0.02. Now, we need to know how many periods we are going to be paying interest as well as principal, which is going to be equal to the 32 period minus the 5 period we are just going to be paying interest rates. So we have 27 periods that we are going to be paying interest rates as well as principal. Now we can calculate the payment to be made for 27 periods, which is equal to payment. The rate we are talking about here is 0.02, the number of periods is going to be 27 periods or 27 quarters, the present value is going to be $25 million, and the future value, that is, after the 27 period, we are supposed to have a future value of 0. Meaning at this time, the company is expected to have liquidated the total loan of $25 million. We close bracket. So this tells us that we are supposed to make 27 quarterly payments of $1,207,327. Now that we have our payment calculated, let us develop our amortization table. We are supposed to develop an amortization table for 32 periods. 0, 1, 2, 3. We just pull that down right up to the 32nd period. Remember that from the first right up to the fifth period, we are told that the company is going to make just interest payments. So this is equal to first period. It's going to be the loan amount of $25 million. Let's fix that, please. And then we just pull that right up to the fifth quarter. Then the same is going to apply for our closing balance. Our closing balance is basically going to be equal to our opening balance. We just pull that right up to the fifth period. So we are told that from the first right up to the fifth period, we are going to be paying just interest expenses. To determine the interest we're going to be paying, this is equal to the quarterly interest rate, we fix that, multiplied by the opening balance in the first period. We just drag that through. So we realize that from the first right to the fifth quarter, we are going to be making quarterly payments of $500,000. Then from the sixth period, we are told that we are required to pay interest as well as principal. In the sixth year, our opening balance is going to be equal to the closing balance of the fifth year. The total payment we are supposed to be making in the sixth year is going to include our interest rate as well as our principal. So let's extrapolate our payments to be made in the sixth year, which is equal to, we move to the calculation of our payment and we negate that value because we want to have a positive value. And our interest rate is going to remain the same, that is, quarterly interest rate, we fix that, multiplied by the opening balance. And we have $500,000. The principal payment is going to be equal to payments minus the interest expenses. Our closing balance in the sixth year is going to be equal to the opening balance minus the principal. So we have a closing balance of $24,292,673. We are going to carry out the same logic in the seventh quarter. In the seventh quarter, our opening balance is going to be equal to the closing balance of the sixth quarter. To get the interest rate, we're just going to apply the same formula, which is equal to Quarterly interest rate, we fix that because we're going to copy paste formula through, multiplied by the opening balance. So the payment is actually going to be the same. So we fix that and we just pinch and pull that right up onto the 32nd quarter. To get the principal is basically equal to payments minus interest rate. And our closing balance is equal to opening balance minus principal. Our opening balance for the 8th quarter is going to be equal to the closing balance of the 7th quarter. We just hold and drag. Then we do the same for interest expenses. We just pinch and drag right up to the 32nd quarter. Then the same should apply for the principal. We just pinch and pull that right up to the 32nd quarter. And to finalize these, we're just going to pinch and drag the closing balance right up to the 32nd quarter. Excellent. So it tells us that in the 8th year, finishing our 32nd quarter, we are supposed to be liquidating these 25 million loan. Now let us make a summary of tranche A loan as well as tranche B loan, summarizing the interest expense as well as principal payment of each and every one of these loans.